Hello, my Pixel peeps. Nicole Payne, CMA, here as always to drop some accounting truth bombs. Today is part 3 of a 4-part mini-series on reading financial statements. If you haven't had a chance, go back and watch parts 1 and 2. They're titled Basics of Financial Reporting and Reading a P&L. But today we are going to do a deep dive into the balance sheet. That is why we're here. And without much further ado, I'm going to jump right in. I'm going to get my screen share set up. You'll see me looking off camera as I'm looking at the screen over here. And if you watched part 1 already, or part 2, the reading the P&L, you know already, this is a sample company provided by QuickBooks. Craig's Design and Landscaping is not a client. All of this information is 100% fictitious. That's just my disclaimer. I do not share client-specific data in my videos, and I would never want any of our clients to be concerned that I would share. So, sample company, all fictitious data, but it's good, useful information for us to actually play around in. So, left menu here, I'm going to go into our report section, and then I'm going to hide the menu so that we have more screen to look at, so we can actually see more details. Again, if you were watching the part 2 video about reading the P&L, you see that this list goes on and on and on. There are so many reports in here. Most of them are useless to our everyday user, but the ones that you find are most useful, you can star them, and then they wind up here at the top of the list in your favorites. And of course, today we're talking about the balance sheet, so we're just going to jump right into that favorite report. Again, as is customary for QuickBooks, it tries to be smart and it tries to default to what it thinks you want to see, and it's defaulting to year to date. I am actually going to change this so that we're looking as of last month. And we'll go ahead and hit Run Report. Now, financial statements. I don't know why they do this. It just is what they do. They always tell you what company you're looking at, as if you don't know what company you work for or own. Anyway, they do it. We're also looking at the balance sheet, so good to know. We're looking at the right report. And this information right here, you might see, is different than it looked when we were looking at the P&L. So when we ran the P&L, it actually gave us the full period that we were looking at, the January through June. The thing about the balance sheet is it looks specifically as a snapshot of a point in time. So even though the information is everything up to that point is cumulatively in this particular report, this is what these accounts had in them as of June 30th, 2021. So that's just how the financial statement or the balance sheet is structured. A little bit more about this structure. The balance sheet has 3 parts. You have your assets, which is everything the company owns. You have your liabilities, everything the company owes. And then the difference between the two is the equity section, which is what the owners actually have, the stakeholders have in ownership. Accounting 101 here for you. The accounting equation is assets equals liabilities plus equity. So liabilities and equity should total to the same as what our total assets come out to be. And we'll talk about that. I'll show you that here in the video. So each of those sections, also the assets, liabilities, and equity, have subcategories. I'm not going to get into the specifics of why they're broken out different ways, but just know that there's a very, very structured, formal, read that old-fashioned way that these reports are structured. So under our assets, we have all of our bank accounts, cash accounts, anything that has to do with the physical money that the company owns. And then it lists out the accounts receivable. In this case, the company has customers that owe them just shy of $5,200 or $5,300. Then they have some other assets here, which is inventory, things that they plan on selling in the future, and undeposited funds. Now, this happens when companies take a payment from a customer, but it hasn't actually been sent to the bank yet. So maybe you received a check today, but it's 5 o'clock and you're not going to be able to make it to the bank till tomorrow. You record the payment today, take it to the bank tomorrow, record the deposit. In the interim, it's that money sits here in undeposited funds. Then they have fixed assets. So in this case, landscaping company, they own a truck. It's pretty reasonable that a landscaping company would need a truck in order to get around and take all of their tools to the jobs that they work. So your asset is listed here at original cost. After you look at all of these different assets, you have this total assets. And right now, the company has total assets of $45,000 as of June 30th. Now we look down here in the liability section. They have their current liabilities, which consists of accounts payable and credit cards. Current liabilities are the things that are expected to be paid in the next short operating period. So usually month to 6 months, less than a year. Then they have other liabilities, which are things like this looks like Arizona Department of Revenue is probably payroll related. They have a loan outstanding, a term loan that they have to pay. And then they have a note payable here under long-term liabilities. So if you were reading or if you were following along with part 1, these loans, this loan payable and note payable, are more than likely what was generating that interest in terms of term loan. So you've got your total liabilities. Total liabilities is $31,000. Total assets is not equal to total liabilities. These two numbers don't balance yet. So that means we've got some equity down here. And you'll see that we've got opening balance equity. I have a video on that. If you haven't watched it, take a look. You have owner's investment, and then, so this is the money that the owner has actually put into the company over the life of the company. You have retained earnings. In this case, it's negative, which means that the company has had losses in previous periods. And then you have net income, which is another form of retained earnings. And QuickBooks keeps it in net income instead of lumping it into retained earnings. But then we have total equity. Again, that doesn't match or balance with their total assets. But when we add our total liabilities and our total equity, comes out to this $45,000, and that matches, or because accountants are so brilliant and so creative, balances to our total assets. So that is a deep dive, a down and dirty of how to read the balance sheet. And if you have questions, comments, concerns, go ahead and put them in the comments. I'm going to stop sharing my screen now. Anyway, I'm happy to have more in-depth discussion about these. If you have particular questions about where something would go on your balance sheet, hit me up. My contact information is at the end of this video. And as always, take care, and I'll see you on the next slide.